Zillow's latest outlook doesn't just hint at a slowdown, it points to a reset. Cities once labeled untouchable are buckling under the same pressure. Payments that don't pencil, buyers that don't show, and costs that hit before you ever touch the mortgage. Pending sales are scraping historic lows, contracts are getting torn up, and inventory is quietly stacking. The headline says cooling, the numbers say something else. According to the forecast your competitor cites, the next leg isn't about bidding wars, it's about pricing power collapsing when math finally wins. If you own, the question is how much cushion you really have. If you're buying, it's how much pain is already priced in, and how much isn't. Markets don't crash because of vibes, they break when the monthly payment blindsides the paycheck. Across multiple cities in the transcript, Denver, Portland, Honolulu, San Francisco, the price-to-income ratio sits at 6 times, 7 times, even 10 times. Put that into a monthly on a mid-tier home, a payment can swallow 40% to 50% of a typical household's pre-tax income before taxes, insurance, HOA, utilities, or anything resembling a life. Buyers see that number and step back. Sellers hold out for yesterday's comps and get radio silence. Then days on market stretch from weeks to months and price cuts follow. Not because sellers suddenly turn generous, but because the comps themselves get rewritten. Affordability isn't a talking point, it's the engine. When it seizes, the car stops, no matter how desirable the zip code sounds. And it's not just coastal outliers. Denver's mid-$600,000 median collides with sub-$90,000 incomes. Portland's mid-500s runs into an $80,000-ish median paycheck. Honolulu's near $900,000 Paradise Premium meets a $90,000 to $100,000 income base. San Francisco, you already know the story, 7-figure prices on a 6-figure income floor with shrinking high-paid demand. When payments become the villain, open houses become museums, lots to look at, nobody taking anything home. But affordability isn't the only blade cutting through demand. In some states, the insurance line item has become the sledgehammer. Florida and the Gulf Coast don't just battle high premiums, they battle uncertainty. In Cape Coral and North Port, your competitor's transcript describes homeowners shelling out thousands a year just to be eligible to pay the mortgage. Add mandatory flood coverage in low-lying zones, and the pre-mortgage bill can flirt with $1,000 a month before a single dollar hits principal and interest. That's how you get cancellations. Buyers sign, then see the updated insurance quote, the HOA fine print, and the tax bill, and the deal evaporates. Builders there flooded the market during the pandemic. Now they're offering $50,000 to $100,000 cuts and sweeteners just to move inventory. A quick discount can get a headline sale, but it also resets comps for the entire subdivision. Resales suffer next because appraisals don't care how much you love your 2022 price tag. If a new build down the street just closed $75,000 lower with quartz and a fridge thrown in, that's the new neighborhood truth. Insurance is supposed to be protection. In these markets, it's become a gatekeeper. And even where premiums are less punishing, there's another tell that the tide has turned: inventory. Before prices fall loudly, listings rise quietly. Days on market stretch to 60, 90, 120. In DC, Portland, Denver, the transcript paints the same picture: the list high, wait/later dance. Sellers anchor to peak year comps, buyers anchor to their monthly budget. The stalemate lengthens until someone blinks. Spoiler, it's always the seller. Each price cut steals oxygen from nearby listings, and eventually that oxygen becomes the new appraisal reality. Watch the condo segments in expensive cities and the production builder tracks on the suburban fringe. Those are the first places to show stress. Condos because investors retreat and HOA costs bite. Fringe new builds because supply is elastic and buyers are payment sensitive. When inventory swells, it's not just a number, it's a clock. Every extra week on market is leverage shifting to the buyer. And there's one thing that converts inventory into real price damage faster than anything else: cancellations. Pending sales are the lifeblood of a housing market. The transcript calls out an index level far below pre-pandemic norms. That matters because pendings tell you where closings will land 30 to 60 days later. When pendings sag and cancellations spike, you don't just get fewer deals, you get broken chains. The would-be seller who was going to buy, their next purchase falls apart too. Lenders tighten underwriting on shaky condo buildings and flood zone risks. Appraisers get conservative, and buyers, seeing one more line item on that monthly, higher HOA dues, higher insurance, property taxes stepped up to today's price, decide to live with their current rental for one more year. This isn't 2008's credit implosion replayed, but the psychology rhymes. Back then, it was exotic loans and a jobs shock. Now it's a cost shock colliding with normal loans and sticky wages. One market a lot of people assumed could defy the pattern was DC, recession-proof, the narrative said. But when even the capital's demand pulse weakens, it's a reminder. No city is immune from math. DC has government paychecks, contractors, and a deep bench of white-collar buyers, and yet the transcript highlights stalled listings and fat price chops. San Francisco rode tech equity and venture wealth. Now, fewer IPOs, thinner bonuses, and softer office demand tug at the high end first, then the mid-tier. Honolulu's Paradise Premium runs into real-world costs, shipping, utilities, and stricter rules on short-term rentals that ding investor appetite. Tourist economies can plateau, remote work can siphon office cores, and even safe employers can slow hiring. The lesson: quality of life sells the dream, but cost of life decides the contract. When high-end demand thins, it doesn't stay in the penthouses. It leaks down because sellers with bigger notes cut faster to protect equity, and when they do, mid-market comps reset. Which brings us to the crowd that accelerates both the rise and the fall: investors. The transcript flags Austin as the post-pandemic showcase. Investors poured in, yields looked great, and cheap money did the heavy lifting. Then rates rose, travel softened, and nightly rates, Jacques occupancies faced pressure from both regulation and competition. Investors don't get sentimental, they run spreadsheets. When the math turns red, they list. When they list en masse, price discovery speeds up. Some neighborhoods wake up with 3, then 9, then 15 for sale signs in a 5-block radius. That doesn't just scare buyers, it arms them. Every price cut becomes negotiating ammo on the next house. The investor unwind is why some boomtowns move from healthy correction to real reset. Owner-occupiers ask, "Can I make this work?" Investors ask, "Can I beat treasuries?" Different question, faster decision. And as those decisions stack, homeowners who thought their equity was ironclad realize comps are being written by the most motivated sellers on the block. If your equity is thin and your market looks like the transcript's problem set, high insurance, long days on market, investor density, stretched price to income, the risk isn't theoretical. The playbook for sellers shifts. Price to today's buyer, not yesterday's neighbor. Offer real value. Closing credits for rate buydowns, prepaid. Insurance months, HOA credits, that hit the monthly. Fix inspection landmines up front to avoid late-stage fallout. Waiting for a buyer to fall in love with an old list price is how a 30-day plan becomes 120 days and 2 price cuts. If you're buying, measure the payment, not the price. If the monthly is a coin flip, the price is irrelevant. Budget for insurance at today's quotes, HOA dues at current levels, and taxes at stepped-up assessed values. And remember, a market can bottom in payments before it bottoms in nominal prices if rates fall, while sellers stay sticky. That's how you get years that feel better but don't look cheaper on paper. The only universal rule is safety margin. Washington, D.C., prestige didn't prevent an inventory pileup. Listings age, sellers slash, and the buyer pool is smaller than the myth suggested. According to the forecast cited, glide path equals lower through 2026. Cape Coral, Florida, insurance shock plus flood risk plus builder overhang. Discounts have turned into comparable sales, not just marketing bait. Portland, Oregon, price to income stretched. Taxes and rising premiums sour the monthly. Inventory rising, pendings lagging. Northport, Florida, retiree heavy demand meets fixed incomes and insurance volatility. Builders cut, resales follow. Honolulu, HI, Paradise Premium meets mainland math. High carrying costs, STR tightening, and slower tourism. Cool investor appetite. Denver, Colorado. Payments dominate headlines. Inventory expanding, pendings weaker. Luxury softness bleeding into mid-tier. Sacramento, California, pandemic. Affordable Bay Area. Narrative unwinds. Taxes, insurance push buyers to the sidelines. Cancellations bite. Austin, Texas. Investor unwind plus oversupply after the boom. Comps rewrite faster in investor pockets. San Francisco, California. Tech-sensitive demand. Condo oversupply in the core. 7-figure medians run into fewer 6-figure buyers. New Orleans, Louisiana, insurance volatility and storm risk weigh heavily. Lower incomes amplify the hit to demand. Housing doesn't move in straight lines, it lurches when the monthly turns unforgiving. The transcript's picture, affordability stretched, insurance punishing, inventory rising, and pendings weak, is exactly how a soft landing turns into a drawn-out reset. If even the safe cities are wobbling, the next 24 months won't be about who has the nicest listing photos. It'll be about who understands the new math first. The bottom rarely announces itself. It shows up as silence at open houses, appraisal surprises, and sellers who blink. The real question isn't, will prices dip? It's, where do payments finally feel livable again? Because that's where the market wakes up.